Scholastic Corporation. You know the brand, right? The book fairs and the school gymnasium, the book clubs, Harry Potter, Dogman. For over a century, they've been putting books into the hands of children all over the world. But looking at the stock today, trading right around $42 a share, we really have to ask a hard question. Is this beloved company actually a great investment opportunity, or is it just a great brand trapped in a dying business model? Today, in this explainer, we're going to run Scholastic through an ultimate 21 model valuation gauntlet to find out exactly what it's worth. So let's just dive right into the game plan. We'll be covering the Scholastic paradox, the valuation gauntlet, the red and green flags, what the investing legends would say, and finally, our final verdict. Starting off with Section 1, the Scholastic paradox, a beloved brand going head-to-head with its actual financial reality. What's really wild here is the massive cognitive dissonance. On one hand, we've got a billion-dollar beloved brand pulling in roughly $1.6 billion in fiscal year 2026 revenue. But the operating income was just $15.2 million. That is a razor-thin margin. Now, Wall Street totally grabbed onto the headline that adjusted EBITDA hit over $150 million, which met guidance. But you've got to wonder, with such a tiny actual operating income, is this turnaround working, or is it mostly just financial engineering? Moving right into Section 2, the valuation gauntlet. Let's see if this stock can survive our 21 model math test. We're kicking things off with Group A, the heavy hitters. These are the cash flow models, like your standard discounted cash flow. Assuming an 8.5% cost of capital and a 3% terminal growth rate, these models cluster right around $38 to $44. So they give us an average intrinsic value of exactly $40 a share. At $42 today, the stock isn't exactly a screaming bargain. But, it's not a massive bubble either. Next up is Group B, the dividend and income models. Scholastic actually just hiked its dividend by 25% to an annualized dollar per share, which sounds awesome for yield. But the models plunge the average down to $34. Why? Because the economic value added model shows Scholastic is actually destroying economic value. They have a net operating profit after tax of about $40 million, but a capital charge of $85 million. So strictly from an income perspective, the math says the stock is overvalued. For Group C, we look at comparables. This is what Wall Street loves to use. On the surface, metrics like an 18.3 trailing PE and an enterprise value to EBITDA of 5.8 look incredibly cheap compared to peers, bringing us to a $41 average. But here is the major catch. You're paying a low multiple for a shrinking pie. The revenue is declining while many of their peers are growing, which kind of makes those cheap multiples a bit of an illusion. Group D, the asset-based models, brings the average out to $35. And man, this exposes a massive hidden risk. The reported book value looks completely solid at roughly $40, acting like a nice floor. But if you strip away the intangibles, tangible book value drops all the way down to just $21.54. That means there's a whopping $350 million in goodwill just sitting on the balance sheet waiting to be heavily impaired if the core business continues to struggle. So throwing all that into the gauntlet, plus factoring in about $7 of speculative real options for their future digital platforms, we land at a grand average of $39 per share. The big takeaway for us here? Buying at 42 means you absolutely aren't getting a discount. You're actually paying a 7 to 8% premium. Let's move into Section 3, red and green flags. This is where we dig into the footnotes the media tends to completely ignore. Honestly, these 7 red flags paint a fairly concerning picture. Notice the total collapse in free cash flow conversion, down 25%. Then there's the debt load. It surged from about $118 million all the way up to nearly $375 million. Oh, and C-level insiders? They just sold off $1.2 million in stock while the company is actively destroying shareholder value with a return on equity of just 6.68%. So yeah, the earnings might officially be there, but the cash is simply not following. But impartially speaking, there are also 7 green flags giving this stock a decent floor. Most notably, management played a really smart hand by aggressively buying back a massive 33% of outstanding shares at an average price of $33.30. That is well below our intrinsic value average. Throw in the $400 million they unlocked from a sale-leaseback, plus 18 consecutive years of paying dividends, and you can clearly see management is pulling every single lever they have to create a safety net for shareholders. All right, Section 4, the legends weigh in. Let's see what Graham, Lynch, and Buffett would think of this setup.
First to the stand is the father of value investing himself, Ben Graham. If we just run his famous Graham number formula, which is purely based on earnings and book value, Scholastic actually looks a tiny bit undervalued, outputting a value of $46 per share.
However, it completely fails Graham's strict secondary tests. He demands a PE below 15, and Scholastic is sitting at 18.3. He also demands a positive net current asset value, which it misses by a mile. So, Graham's final verdict? A very firm would not buy. Next, we bring in Peter Lynch, the champion of growth at a reasonable price. He leans heavily on the PEG ratio, where any score below 1.0 is considered a fairly priced growth opportunity.
Well, with a trailing PE of 18.3 and an estimated growth rate of just 9%, Scholastic's PEG ratio shoots up to a highly expensive 2.0. That essentially means the stock fundamentally fails Lynch's test for the actual growth it's delivering to shareholders. So Lynch's verdict? Also a would not buy.
Finally, we ask Warren Buffett. He's all about underlying business quality, so he focuses heavily on return on invested capital, or ROIC, alongside owner's earnings, to see exactly how efficiently a company turns its capital into profit. While Scholastic's owner's earnings and debt levels technically pass his test, they have a truly dismal 4.7% ROIC. Buffett demands at least 15%, so that is an absolute deal breaker for him. That brings us to a sweeping rejection from all three legendary investors. Which leads us directly into Section 5, the final verdict, our mode assessment, and the absolute bottom line. Using Morningstar's 5 sources of competitive advantage, let's look at the moat. Sure, the brand is incredibly famous, but those intangibles are actively eroding. Switching costs are super low because schools can easily jump to Pearson or pure digital alternatives. When you factor in the massive digital disruption and declining book fair participation, Scholastic's once mighty moat is definitively narrow and shrinking fast. And this visually sums up our ultimate conclusion. With the current price at $42, the intrinsic value average at $39, and the dividend models dragging it down to $34, Scholastic is trading at a premium across the most rigorous models we have. That means the required margin of safety, that essential buffer between price and intrinsic value that investors rely on, simply isn't there. So what's the ultimate bottom line of this explainer? Look, management is doing the right things. They're aggressively buying back stock, raising the dividend, and doing everything they can to cut costs. But the fundamental reality is unavoidable. This beloved century-old brand is structurally a shrinking business fighting digital disruption. It offers very limited upside with some very real downside risk. Our 21 models point to fair valuation at best, but those hidden red flags suggest a storm is definitely brewing beneath the surface. So based on all the structured evidence we just went through, which side of the trade are you on? Are they quietly poised for an epic digital turnaround, or is this just the ultimate value trap? Take the data, do your own homework, and decide for yourself.